Hey everybody, welcome back to the channel. Today we're going to be looking at the ETFs that have performed the best so far in 2025. The markets have been a little crazy the last few weeks. So what I wanted to do was provide you guys some insight onto what ETFs are actually going up in these very volatile times, while also cutting through the noise and maybe just providing a little education on what to look for and what not to look for. So if you're using FinViz, this is the filters you're going to be wanting to use essentially. You can see my screen, my head is blocking it, but we have performance year to date is up, and I'm on the ETF performance down right here. It's in blue. So I've gone through 4 pages already, and the things ETFs you want to avoid that are very volatile, and I'll find some examples here. This one is ultra short healthcare 2x. Now, this is fine and dandy for when healthcare is not down. However, most of the time, healthcare generally might be up, and this ETF, we don't know if it has very volatile biotech healthcare companies in there that could spike up and make this go down, since this is a short. So they're betting that the stock is going to go down. When it goes down, you make money. But they have to be, exposed to some companies that may not look too good, but if they get some really good news, could move. Another one to potentially stay away from, shorting small caps. For example, it could be mid caps, small caps, it could be utilities, water, etc. When they're shorting a sector, the small cap sector for this example, I mean, the markets generally go down for a short period of time, looking back at history. So being into we'll just open it. I'll just show you as an example. So being in a ultra short ETF, it's going to look like it's going downhill, and then it'll get a little boop, boop. And I'm guessing that's what we're going to see here. While it's loading, don't forget to drink water. Okay. It's going nice and slow for us. I love it. Okay. We were probably going to have to come back to this because it is taking too long to load. We'll come back to it. And again, short the mid cap 400. We got this Cambria tail risk ETF that we're going to look at as well. ProShares short again. Ultra VIX short term. So a lot of these are more of in and out kind of trades. And I want to see if ProShares have loaded yet. Not yet. So we're going to look at our first ETF, that is the precious metals. So this was within the first 4 pages. And again, the precious metals is not encapsulated to just gold or just silver or just diamonds. So this has a few classes it's exposed to. You can see down here, gold, short-term trusts from the government, treasury, silver, short-term treasury ETF as well. So this has a decent mix, and it also is going to pay you 3.84% with a 0.77% expense ratio, which is fine. So here you're exposed to gold and silver if you are into those. And if we go back in time, let's just see how far back we can go. Our lowest of the low was back in $30 at 2016, 2015. Again, you'd be better off getting in the S&P 500. However, if you purchased this in 2011 at $68 a share, congrats, you just broke even. So this is a ETF to consider. It is up, but it is again very hyper focused on silver and gold. So not anything amazing. We're just gonna pass on it. Here's a newer ETF. This one's interesting. It pays 4.24%, which is amazing, with an expense ratio of 0.76, which is good. The expense ratios, think of it as every $10,000 you invest, you're going to pay $76 every year. So you're going to get 4% for the year. You're going to pay $76 fee. The money you're going to get from your dividend is going to pay for that, which is good. And this one is just basically futures contracts, some government bonds, looks like 5-year bonds. So overall, this thing looks pretty steady, and this is how we can kind of tell. The low triple bottom was $23, the double top was $29. $6 swing. I mean, that is a pretty aggressive swing over 2 years for bonds. But if you're looking for somewhere to park your money and not be too worried in a $6 swing, this one could be a potential candidate. We also have this ETF called TAIL, and this is exactly like the ProShares short I'm going to show you right now, potentially. Where basically, yeah, over, and oh man, I've been blocking this whole time. Basically, over time, you're better off being in the S&P 500, but then now we've got a glimmer of hope. So if you've been in this one, it's just a losing battle. Like if you've ever bought into this one at any period of time, you're down money. So again, these are only short-term trades. So I would avoid like the ultra shorts, ultra longs, etc. Back to the tail end. This one is similar to what we just looked at. It has treasury notes and cash. That makes up 83%, with a little bit of S&P 500, a little bit of a put here. Treasury, we have more S&P, put options. So it's very, I guess the correct way to put this is safe. 83% is in treasuries and cash, while 3% is in S&P. Well, I guess you have 3 plus, so 5, 6, 7, 8, 9. About 9% is in S&P 500. Then you've got puts. So this one's decent, but again, you're playing a losing game here. At any point in history, any time in history, you've lost money. So avoid companies like, or ETFs like this. Okay, this is a newer ETF. We have to just be aware and call it out. It pays 3.6%. That's really good. Good expense ratio. And we need to confirm. So what we can see here is a really great diversification of utilities, which is fan-freaking-tastic. So this is global infrastructure. Look at how well this was moving prior to the last 2 weeks. Absolutely incredible. It's gone from $24 to $34 in a matter of a year plus, while it's also paying a 3.6% dividend. So I think this is a really good option if you're looking to diversify for an income infrastructure ETF. I want to say it's been performing very well. And again, this is a great diversification here. And it has 34 holdings. And if you're on FinViz, you can just click show all. And it's going to show you all of these. Too bad it doesn't show you the country. That would be cool. So the number 1 is Enel Spa. That is their top holding. And then Dominion Energy, which is very popular. And then Hess. Hess was doing well. So again, this is a decent global, if you're trying to get some global exposure, not just the US, because the US is going a little crazy right now. Now we have a Europe Financials ETF. Again, let's just zoom out on this one. Wrong way. This one has basically been flat since 2011. It was as high as $24.24, and it's basically been flat, but you have your dips to 13, rips to 26, 100%, dip to 14, rip to 26, dip to 10, rip to 30. So overall, not too horrible. Again, this is European financials, 5% dividend. That is amazing. Very low expense ratio. Again, great diversification of companies, 105 different holdings here. So you're very, very spread out across the European financials. I don't know what is to dislike about this one other than it got really hot here. And now I think we want to see this come back down. So keep an eye on this one. Would love to see it come back down to 13, but we just don't know the future. So keep an eye on this one if you are interested in European financials. And you'll notice with all these that we're looking at, they're very hyper-focused. Again, precious metals, European financials. Now we're looking at anti-beta funds. Again, this one's basically been flat. Looks like it IPO'd at 16, got as high as 24. 18, got as high as 24, back and forth, back and forth. Let's look at the holdings here and see what they're paying. Paying 3.6, but you're paying a 1.43% fee. Not too bad. You can see 94% is cash. Then we've got these other positions here, which could be, so it looks like a long and a short. BTAL U25 long, BTAL short. You can see they cancel each other out essentially. Celsius, are they shorting Celsius here? United States Steel, United Healthcare, BJ's Whole Club. So it could also just be a decrease in holdings. So they're holding a lot of positions. Great diversification. Year to date, it's up 13.9%. That's pretty fantastic. Overall, this is about halfway where we'd expect it to be. Going back to 2012. So again, not anything too crazy here. Most of this position is cash. So this is a very safe play. Like one of the other ones we looked at earlier, that was a lot of notes and bonds. It's paying 3%, but you're paying a higher fee here. So just be aware. And then the last one that I found within the first 4 pages was the Global Utilities ETF. Now this is fantastic because it gives you the global exposure. It's not just the US. And I believe it pays a nice dividend. 3% dividend, very low expense ratio. And you can see here, fantastic diversification here. Nexair Energy has 7.8%, and then it goes down to 5% at Southern. But overall, like, you cannot complain. There's 83 different companies inside this Global Utilities ETF. And going all the way back to the financial crisis in 2008, where it bottomed at $33, it's only ever gone up, and you've been collecting a nice dividend along the way. So I cannot hate on this one. I absolutely like this chart. Basically, long term, it's just following a mean here. If we can get this stock to hold 61, see how it interacts, or if we can get it to come and touch the bottom of the Bollinger Band. So right here is our bottom Bollinger, this blue. Then we have this purple, which is our upper. You can see it hits the upper, comes down to the mid, goes back to the upper, comes back down to the mid, which is this middle purple, goes to the bottom of the Bollinger, gets to the mid, creates support, tries to break up, gets to the bottom, gets to the mid, gets to the top. So it's a very slow and nice play. If you're someone who wants to stay away from very high volatility, market gut-wrenching news, flashes, breaking news. So this one's great long-term, in my opinion. So we looked at some fantastic ETFs. I appreciate you if you made it this far. Consider engaging with the channel, whether that's liking, subscribing, disliking, or sharing or something. That's all I got for you. I'll see you in the next one.